In the last few episodes, we've been understanding how India's financial system works. We looked at banks, we looked at NBFCs. Now we move the layer that touches everyone every day, payments. Every time you scan a QR code, swipe a card, receive your salary, or see an EMI deducted from your account, you tap, approve, and within seconds you see a simple message. Payment successful. What you don't see is what makes that possible. Behind every successful payment is a carefully designed system working silently in the background. Multiple regulated participants, multiple layers of infrastructure, all operating together in real time at a massive scale. India did not build a digital payment as one app or one product. It built payment as an ecosystem. In this ecosystem, different participants perform very different specific roles. Some build shared rails, some enable merchants, some issue payment instrument, some route transactions, and some handle settlements. And every one of these participants operates under the oversight of Reserve Bank of India. In this episode, we'll break down the India's payment infrastructure exactly the way it is designed. Who the participants are, why each one exists, what role each one plays, and how money actually moves from one account to another. So let's begin with the foundation of the system. The first participant is NPCI, which acts as the shared payment infrastructure for India. At the center of India's payment ecosystem sits NPCI. NPCI stands for National Payment Corporation of India. NPCI is not a regulator. It does not deal with customers. It does not hold your money. Its role is far more fundamental. NPCI exists to build and operate shared payment infrastructure that all banks can trust. Before NPCI, banks largely operated payment systems in silos. Interbank transfers were slow, ATM networks were fragmented, scaling a national payment system was difficult. NPCI was created to solve this coordination problem. Today, NPCI operates some of the most critical payment systems in the country. It runs UPI for real-time bank-to-bank transfers, AePS for 24/7 interbank transfers, RuPay, India's domestic card network, NACH for recurring debits like EMIs and SIPs, AePS for Aadhaar-based banking access, FASTag for toll payments, and the National Financial Switch that connects ATMs across the bank. NPCI does not innovate at an app level. Banks and Fintechs do that. NPCI focuses on something else: reliability, interoperability, scale, and trust. This shared infrastructure is the reason India can process billions of transactions every month at a very low cost without the system breaking. NPCI is the spine of India's digital payments economy. The next participant is called the payment gateway, which operates as the technology layer of digital payments. When digital payment first started growing online, merchants faced a basic problem. How do you securely collect card or bank details from a customer and send them to the banking system? This is where the payment gateways came in. A payment gateway is a technology layer. Its job is to securely capture payment information, encrypt sensitive data, and route transaction details to bank or card networks for authorizations. Gateways focus on security and connectivity. They make sure card details are protected, they make sure transactions data reaches the right system, and make sure response come back reliably. What payment gateways do not do is handle money. They do not collect funds, they do not settle payments, they do not hold merchant balances. As digital payments scaled, RBI made a clear distinction between technology providers and entities that actually handle funds. That distinction becomes more important when we talk about payment aggregators. But even today, gateways remain a critical part of payment stack. They are invisible technical layer that makes online payments possible. The next participant is payment aggregator, which enables merchants to accept digital payments. As digital commerce grew, merchants needed more than secure transmission of data. They needed one partner who could manage everything: merchant onboarding, multiple payment modes, settlements, refunds, compliance, reconciliation. This is why payment aggregators exist. A payment aggregator allows merchants to accept UPI, card, wallets, and other digital payment through a single integration. The aggregators onboard the merchant, collects payments from the customer, temporarily holds the fund in a regulated escrow account, and settles the money into the merchant's bank account. Because payment aggregators handle merchants' fund, RBI regulates them tightly. They must follow strict rules on settlement timelines. They must maintain an escrow account. They must comply with KYC and AML norms. They must follow detailed reporting and risk management requirements. RBI also recognizes cross-border payments aggregator. These entities enable India's merchants to accept international payments or facilitate outbound payments under the foreign exchange rules. Because cross-border payments involve currency conversion and data movement, they operate under even stricter oversight. Payment aggregators are allowed to collect and settle payments, but they cannot lend money unless they hold a separate lending license. Their role is clear: make digital payment easy for merchants at scale while keeping their systems safe. The next category is prepaid payment instrument, which allows store value payments. Before real-time bank payment became widespread, India needed way to enable fast, small and digital payments. This is where PPI came in. PPI allows a user to store value in advance and use it for payments. Wallets, prepaid cards, gift cards and transit cards all fall under this category. Because PPI involves stored customer value, RBI regulates them carefully. PPIs cannot pay interest, balances are capped, KYC requirements apply, lending is not allowed. As UPI matured, PPI stopped being the primary payment method for most users, but they did not disappear. They continue to play an important role in specific use cases: transit system, gift cards, closed-loop ecosystems, and platform-based payments. Today, PPI functions as a regulated supporting instrument inside India's broader payment ecosystem. The next participant is a card network, which coordinates how card transactions move. Card payments work very different from a bank transfer. When you swipe or tap a card, money does not move immediately. What moves first is a message. A transaction request is sent for authorization. Card network exists to standardize how these messages move between merchants, banks, and payment systems. Networks like Visa, MasterCard, RuPay, and American Express define transaction routing, security standards, fraud rules, and dispute resolution process. Banks issue cards and manage customers' accounts. Card networks do not issue cards. They do not lend money. They do not hold customer funds. Their role is coordination and interoperability. India originally depended on global card networks. To reduce cost, improve domestic acceptance, and retain control over critical infrastructure, India launched its own domestic card network, RuPay. A recent evolution in linking of credit cards to UPI, which currently works only with RuPay credit card. This allows credit to run on real-time payment rails while still remaining within the domestic infrastructure. When people think of UPI, they usually think of the apps on their phone: Google Pay, PhonePe, Paytm, Bheem. But these apps are not UPI itself. They operate as a specific type of participants called the third-party app providers, or TPAPs. TPAPs are officially recognized participants in the UPI ecosystem. Their role is to provide user interface and initiate payments. They allow you to enter the amount, choose the bank account, and approve the transactions. But TPAPs do not move the money. They do not hold your bank account. They do not decide whether a payment is approved. When you make a UPI payment, the TPAP only sends request forward. The actual movement of money is handled by bank. Your bank acts as the issuer. It checks your balance, applies risk rules, and authorizes the debit. The merchant's bank acts as the acquirer. It receives the fund and credits the merchant. Sitting between these banks is NPCI. NPCI acts as the central switch and rule enforcer for UPI. It routes the transaction, ensures interoperability, and keeps the system stable. This separation of rules is intentional. TPAPs focus on user experience and innovations. Bank control money and manage risks. NPCI ensures fairness and system stability. Because TPAPs do not control funds and do not control settlements, UPI was able to scale safely. This design is why UPI grew from an early experiment into a national payment utility and now is being adopted globally. The next system is AePS, which enables Aadhaar-based banking access. AePS stands for Aadhaar-enabled payment system. AePS exists to bring banking access to areas where traditional branches are limited. Using Aadhaar and biometric authentication, people can withdraw cash, check balance, receive government benefits, and transfer money. All they need is Aadhaar, a fingerprint, and a local banking correspondent. AePS is not designed for urban convenience. It is designed for inclusion. It connects rural and remote population to formal banking system and plays a critical role in government benefit deliveries. The final participant is payment switch, which routes the transactions between systems. This is a layer most people never hear about, but without it, payment would stop instantly. A payment switch is the engine that routes transactions between systems. It decides where a transaction goes, how it's processed, and how the response comes back. There are switches for ATM transactions, switches for card payments, switches for UPI, and internal switches inside every bank. Transaction service providers build and operate this infrastructure for banks and payment entities. They do not issue instruments. They do not own the customer relationship. Their role is operational reliability. Because switches sit at the heart of money movement, RBI treats them as a systematically important infrastructure. Here, stability matters more than user experience. Now let's bring the entire payment ecosystem together. When you look at the system as a whole, the structure becomes much clearer. NPCI builds and operates the shared payment trails. Payment gateways provide the secure technology layer for transactions. Payment aggregators enable merchants to accept and settle digital payments. Prepaid payment instruments allow stored value payments under regulation. Card networks coordinate how card transactions move across banks. UPI works through multiple participants, including TPAPs, banks, each with a defined role. AePS enables banking access and inclusion in rural and remote areas. Payment switches route transactions and keep all systems connected underneath. Different roles, one mission: to move money safely, instantly, and at a massive scale. With this episode, we complete our deep dive into RBI's world. We understood how banks are structured, how NBFCs power lending outside banks, and how payments and financial infrastructure move money across the country. Together, these form the foundation of India's financial system. From here, we move to the next regulator, SEBI, which we will cover in our next episode. Before we wrap up, one quick note. If you're entering BFSI or Fintech or preparing for an interview in this space, this entire series is designed to give you the system level clarity most people never get. And I'm currently building a structured course on top of this foundation to make people job ready and interview ready in BFSI. And if you want to join the waitlist and get updates when it launches, you'll find the link in the description. Subscribe to the channel to keep getting regular updates from the series. I'll see you in the next one.